What's going on, everybody? Welcome back to yet again another Markets in Focus. It's currently 7:52 a.m. Eastern Standard Time on December 26, 2023. This is the last week of this year. Happy holidays. We have a 4-day week here. Understand that if you're opening up contracts on the options chain, you're going to have one less day worth of data to work with. We also have next Monday off as well, so just take that into consideration. Let's talk through it. It's been a great year. If you were a bull, if you were a dumb and just went long and waited, you probably made a lot of money this year. Let's talk about what we can reasonably expect this week and maybe open some positions that we could be holding in towards, the latter half of next year, maybe through Q1 and Q2. We'll see what we find. IWM up 2.63% on the week. I think that's kind of the most important part of the market right now. The small caps really outperforming. Something that we've been talking about for the last 6 to 7 weeks. We expected small caps to start outperforming, and they did almost exactly where we expected them to. If you've been following our content for at least the last few weeks, you have exposure right now in that small and mid-cap space because of this idea called the January effect. We'll go through that in 1 second, but it's important to understand that these seasonality trends, although they might not be mirrored one-to-one, might not have a perfect correlation, they generally move in the direction that seasonality expects because we have so much data going back 50, 60, 70, 80 years that these seasonal trends play out. And so if we start to see even the beginnings of some of this, it almost makes sense just to go in that direction, find your risk levels. Make sure, obviously, you have a stop if it doesn't work. But overwhelmingly, they do end up playing out. And in this case, IWM right on schedule with that January effect, outperforming everything else in the market. And we expect this to continue the very minimum through the end of January. So we still have an entire month. If you have that small mid-cap exposure, this should be a very, very good next 4 to 5 weeks for you. But nearly everything across the board was up. We look at the Qs. We look at some of the growthy areas, Bitcoin, etc. Just a really, really nice week in the market. Right? And Friday started the Santa rally. The Santa rally is going to run through the first trading day, I believe, of next year, January 3rd. So we have this entire week, and then we have until Wednesday of next week of this Santa rally. Everybody wants to talk about how everything's supposed to go parabolic. That's not how this works. It's just statistically the highest probability worth of day grouping of days, right? That the indexes are going to pop anywhere between 1.5 and 2%. We don't know exactly which days, but statistically, once again, we can go back 50, 60 years and see this phenomenon playing out. We do expect the indexes to end up 1.5 to 2% to the upside by the end of January 3rd, and we're starting to see it. Last week we started. This morning here, early, the markets are up. We'll see if it still continues, right? You should be looking to trade with the primary trend, and right now the primary trend is up. So everything looks good from an intermarket analysis standpoint. Let's take a quick look at the sector and industry stuff that we normally do in here. Let's go to the 3-month, and let's just get a general idea of what are we looking at owning right now. Nearly everything across the board is something we're looking at owning, which is kind of a problem, by the way, right? When everything starts to look good, you have to make a difficult decision as a trader in terms of where do you want to allocate your capital. Right now, tech is still outperforming on the 3-month. You still have to have your eggs in the basket for tech names, right? But it doesn't have to be necessarily mega cap tech names. It doesn't have to be Apple, Microsoft. It can, right? We have positions in Microsoft still right now that are up and free into triple digits. We're looking for a continuation pop off of the all-time high move, but you don't have to, right? We also have some small mid-cap exposure into that tech space as well. Things like Sentinel One, things like Robinhood, etc. It just makes sense to be along that area, but look at all the other sectors that are starting to outperform the S&P 500. You want to be really looking at these sectors right now and asking yourself, can I grab a piece of these? Now, we're going to go through the concept of higher beta and lower volatility stocks in a second one more time because I think it's very important. I know we've done it for the last few weeks, but it's playing out. So if you're not aware of that, you should be. So does it make sense to lock capital up in a lower volatility name when higher beta names are breaking out right now? Maybe not. But looking at this grouping of sectors here, any of those are fair game right now to start getting long or remaining long if you're already there. And I'm going to go ahead and specifically point out XLF, which we're going to go through at the very end here with the trade idea. It is going to be a financial name. 3-month here on the U.S. Industries tab, you could see regional banks right up there, right? Nearly outperforming everything over the last 3 months. This is your higher beta financial industry. This is what we're talking about, right? If you've been following the content, we got long CUBI, we're long Key. The Key trade is up and free right now, which is the best position we could be in. We have like 4 or 5 months still left on this play. The CUBI trade is up nearly 20% spot. I mean, it's an awesome opportunity to get long these regional banks off of a potential rate hike cycle done. That's terrible English, but you get what I'm saying. And now all of a sudden the banks that didn't die are all of a sudden getting bought back up. Some of the interest rate plays are getting bought right back up. Home builders leading over the last 3 months, semiconductors, software, just normal stuff that we're already long, right? But once again, focus on the areas of the market that are outperforming SPY here. You can see all of the ones right there. And I do encourage you to go through Koyfin and look at this stuff yourself when you have a second. Let's wrap it up by looking at the market caps here in Koyfin. Great tool, by the way. Highly suggest checking it out. I make no money for for saying that, but I absolutely love this tool. Small cap value, right? Small cap value outperforming over the last 3 months. Is it reasonable to assume a lot of that's going to be your regional banks? Yeah, absolutely. Small cap value is basically a majority regional banks right now. I think they're overweight regional banks, which makes the most sense. But once again, we're talking about that January effect kicking in the middle of November to beginning of December. Last 3 months here, outperforming the S&P 500 by over 4%. And this is exactly what we expect. This is why, as a trader, trading decisions on what types of stocks you're trading, given the current market environment, are incredibly important. You have to be willing to go buy the areas of the market that are outperforming, or you're just going to underperform. It's going to be a harder trading environment. So we know where we want to be wrong. The more growthy, higher risk areas of the market are working right now. We don't expect that to change. We're in the middle of the Santa rally. If you can find quality breakouts right now, maybe throw a couple chips out there and see how they go. Maybe a little bit wider of a stop because we are going in towards a more volatile time of the market. But let's see how this stuff works. So over the next 4 slides here, I want to show you, it's going to be a little different than how we normally run it. We're going to look at a bunch of different Twitter stuff, but it's all this macro idea. So I want to challenge you guys going into 2024, specifically the day traders that are watching this content, because you're watching this and you're probably thinking about, man, it's probably time to start messing around with swing trading. Otherwise, you wouldn't be watching this type of stuff. I'm going to tell you right now that if you just bought stocks this year or options contracts with 6 months, even if you bought them at the worst possible time, you probably made a couple bucks this year. So if you're red on the year, you really got to ask yourself, is it the market's fault, or is it maybe a breakdown in your process? You're not buying enough time. The trends have been so strong this year. I mean, the Qs have an opportunity here to set a historic year-to-date performance up like 55 or 60 fucking % in a year. It's absolutely insane. So I want to challenge you to hold your trades longer in 2024. Grab quality positions in strong sectors and hold them and watch how much better you outperform. So let's go through some of this stuff really quick. I want you to look at some of this macro data that's coming out. A majority of these charts are from the stocktradersalmanac.com. Highly suggest grabbing it. If you're a stats guy, it's really good. But I want to point out the 4-year presidential election cycle here going back to 1949. Now, this specific chart was posted in June of this year, and you can kind of see what happened in July. We had hit a corrective phase just like we normally do. And then what happened at the end of October, beginning of November, and towards year end, we hit a rally just like we normally do. And then the 4th year of the election cycle here, we have a pretty goddamn good year again. It's generally going to be a bull market once again. And I think it's important to understand that although this doesn't have to happen, overwhelmingly, a majority of the time it does. And so if you can kind of define your market environment, it makes trading decisions just a little bit easier. Like, should you really be looking to go short next year as an overall thesis? Probably not. Probably not. The historic data says you probably shouldn't. So being more long than short next year is probably going to be the way to go. One thing that this specific chart does not show you is that, and I'm no politics in here whatsoever, I don't give a shit who's president, but if there is a sitting president seeking re-election, it is even more bullish. Right? You want to extrapolate out why, totally fine. But as of right now, I believe President Biden is looking for re-election. And so therefore, this should give even a more positive pop on the 4th year of the presidential election cycle. Once again, this is a fun data point. We have a lot of years going back, a lot of different presidential cycles factored in here. And for the most part, this stuff trades very, very closely. Let's look at that January effect we were talking about. Right? So we posted this back on November 14th. If you're inside TTI, you've seen this so much, you probably don't want to see it again. But realistically, going back to about the beginning to middle of December, the Russell 2000 outperforms the Russell 1000. What does that mean? Small caps are bought at a greater rate than large caps. So it was time to go long small caps back in the middle of November. And that's exactly what we did. It was just icing on the cake that we had undercut into 3-year lows, and then we're screaming back up towards that 200-day moving average. And so it gave a lot of people a great head start on getting long this specific group of stocks. And now we're starting to see them really outperform. We're going to see it in a second on an absolute basis with TradingView. IWM is breaking out, baby. Is it exactly because of this January effect? I'm not too sure, but this type of data historically going back makes a lot of sense and has helped us influence our decision to get long, smalls, and mids. So continue to ride this out. Historically speaking, it does start to tap out towards the middle to end of February. We'll see if that ends up playing out as well. A great Great chart here by Jay Capel. He says a percentage of SPY stocks above the 50-day moving average crosses above 90%. Since 2000, SPY higher 98% of the time 12 months later. And 98% of the time, 98% of the time, SPY is greater 12 months later when you have this many stocks trading above their 50-day moving average. If I don't know how much more I can tell you guys that you should probably be looking to go more long than short next year. Forget what people say and just look at the data. Look at the price. Look at the history of when events like this happen. Forget what everybody is screaming on Twitter and the media that the world's going to end and there's a recession. Motherfucker, we've been talking about a recession for 2 years now. And if it's going to come, the market doesn't give a shit, probably because everybody expects it to happen. And it just so happens that the market doesn't like giving people layup trades. So if you traded for a recession this year, you probably got run over. Let's just call it how it is. 98% of the time when this many stocks are above their 50-day moving average, the S&P 500 is up 12 months later. So trade accordingly. We're talking about holding trades longer. I posted this a few days ago, looks like 8 days ago, something like that. I want you to look at the overnight intraday returns for major stock market indices. And I want you to go and actually look at this. If you don't believe me, go pull it up. I believe this is from Bespoke Investment Group. Could be wrong there, but you can see all the different country ETFs and what it looks like. The blue line is overnight if you were to hold it, and the green line is intraday. And once again, if you have qualms about holding positions overnight because you're afraid that the market's going to dump on you, I want you to understand that historically the market goes up more than down, specifically overnight. So buy enough time and you're not going to get absolutely destroyed. I'm telling you. Hold your positions longer than you think, and you will probably have a better year than you expect. Stop the day trading. If you're already on the fence, don't day trade anymore. Just switch over to swing trading and see what it's like. If you're doing a little bit of both, here's the data to support your thesis, right? Last thing I want to point out here is just to fine tune on this after hours versus regular trading hours. I couldn't find the actual graph, but if I just, you type in Bespoke Investment Group overnight, there's a lot of data here supporting. I just clicked the first one. If you bought the close and then sold the next open versus buying the open and selling the close, going back to 1993. I believe this was posted at the beginning of 2020. You can see the overperformance in buying the close and selling the next open. The biggest moves in the market happen overnight. And if you're afraid to hold through gaps, buy enough time to where you get enough gaps in your favor and you're going to probably make money. It's an easier way to trade. I'm telling you, it's an easier way to trade than day trading. So if you're on the fence in 2024, buy time, close your fucking eyes, believe in trends. If you need to wish upon a star for this stuff to work, feel free. But I guarantee you, give this enough time, you're probably going to outperform your performance from this year, especially if you're on the fence. So let's look really quick at TradingView. This video is already going a little bit too long. We're going to go through, I was going to go through all 3 or all 4 different ETFs here, but indexes, I should say, but let's just focus on the IWM because this is the most important one. We're getting the breakout, right? This is what we've been positioned for going back, like I said, 6 weeks now. We're finally getting the stage 2 breakout off of this 2-year consolidation. Is it reasonable to expect we're going to pop back up towards that 220 area and then potentially all-time highs? Yeah, absolutely. I think it's within the cards. No idea if it's just going to happen overnight. Probably not. We have this low volume node up towards that 220 area. But we do expect over the next few weeks that we are going to be up in that area, right? Whether it's going to take 4 weeks, 6 weeks, 8 weeks. If we go through the end of February and we're at 220, that's fine. But the general direction that we're trading is IWM and small caps in general are going to be being bought. Therefore, we want to be positioned for those. Let's look at high beta, specifically high beta versus low volatility stocks here. We talked about this before, but I think it's still important. If we look at high beta stocks and divide them through low volatility stocks, you can see that over the last 2 years, 2.5 years, we've been basing and we're starting to break out here. I do think it's important to understand that if you have a finite amount of capital, which all of us do, you should probably be owning these high beta names and not low volatility names. It's the same idea as, for example, in TTI, you had an opportunity to go along Sentinel-1 or Costco. Costco popped up 10%. Hard to say that was a bad trade. Sentinel-1 popped up 25%. Well, which one was the better trading decision if they were both relatively the same sort of setup? It was Sentinel-1, right? So right now, the market is buying higher beta names more than low volatility names. Don't get suckered into a market where everything is pumping and you think that I made the right decision because I made a profitable trade. It's a bad decision if you could have made a better trade. Right now, all of the data is supporting this higher beta area. Let's go ahead and wrap up the TradingView portion, at least before the trade idea here. ARK finally breaking out into a stage 2 breakout potential here, kind of giving a little bit more opportunity for those higher beta stocks. This is going to open up a lot of different trade ideas over the next few weeks if ARK does actually stick this above 51 Love this. Absolutely love this. It's going to make trading a lot more fun when the higher beta shit stocks from Cathie Wood really start pumping. It's going to give us a lot of different vectors of attack here, but also IPO, another area of the market that is finally breaking out after a near 2-year base. Once again, stage 2, and this specific space of the market, right? More recent IPOs, they're higher indebted, higher risky companies starting to break out. Once again, some of these are owned by Cathie Wood. Going to give us a different vector of attack. But can you tell that the theme is different in the market? It's not just the blue chip stocks, the Microsofts, the Apples that are running, the Nvidias, although Nvidia probably will continue to run. The market is now buying the shit stocks. That doesn't necessarily mean the top's in. As a matter of fact, we based down here for almost 2 years. I think it's time that the market is going to start buying these, and we need to follow, right? Just follow the price action. You see these higher risk areas breaking out, go and buy those. Last one I want to point out is just the Dixie. The Dixie, this chart rules. Right, this chart has ruled the market for the last 2 near 3 years, coming up on inverse correlation. Dollar goes up, the market goes down. Dollar goes down, market goes up. Dollar consolidated for a majority of 2023. The market went up. We caught a little bit of a rally at the beginning of July through the October high, which makes sense. We peaked at the beginning of October, been in a relative downtrend since, and the market has obviously used that opportunity to pop up. But where are we right now? All right, 101.7. We do expect we could come down and retest this 100 area, which should give the S&P 500 an opportunity to hit an all-time high. But I think it's going to be important. You know, we're obviously bullish. We want to be bullish through the next year. All of the data is supporting that. But what is the dollar going to do at this $100 area? If it does bounce, I think it's going to create a little bit of havoc at the all-time high spot for stocks. And think about all of the different people that are chasing the all-time highs here because they're dum-dums and they haven't been getting long over the last 6 weeks. I think it will make it a more challenging environment if the dollar starts to bounce off that 100 area. I think we will continue to draw down in the short term, but we'll see what happens at that dollar spot. So a couple trades that we're in. Quick updates here. If you're in the Uber trade with us right now, this is a massive win. Obviously, we got in off of this 47.48 flip. We're looking to add in at 64. If you're in this trade right now, please just make sure you should already be free. You should be up multiple hundreds of % on the last portion of your contracts. Close them out at 64 unless you want to continue to let them ride. We do have Marches, right? So we have plenty of time on this. We are looking to add in additional contracts on this 64. We're going to go out to like the Junes or something like that. We're going to be targeting up near $90. The key trade, another trade that we were talking about. This should be a free trade as well. It's meandering up towards its first price target at $15. When we get to 15, chip a couple off. This is already a free trade. We should be up over 100%. Some of you guys are up over 200%. At $15, chip a couple off. Let it keep running. We are not going to add it on this trade, but it is an awesome trade. We have till March. The Hood trade was a trade that we opened up last week, and some guys opened it up a week before that. Finally up. Took a little bit here, but we're finally up and clearing overhead supply here. This is a potential stage 2 breakout. My current position's up 50%. I have a full position on this thing, so I have not taken any off. Remember, at 100%, please take half off to remove all principal from the trade. All you're trading with then is house money. So it's a lot easier to manage this stuff. And then up near that $15, go ahead and take another quarter position off. Do whatever you want with the last one. That's what makes discretionary trading great. You can close it all. You can let it run. We have a lot of time on these May 15s. So, I mean, you know, we have another 5 months on this. Let's talk about the trade idea for today. So we're talking about owning a lot of the financial stocks. Regional bank stocks right now look great, but there's not a lot of setups. This Wells Fargo, I was kind of scanning through some stuff. Wells Fargo giving us a decent opportunity here for grabbing a large cap financial name. I can't believe I'm saying that we want to own Wells Fargo. I can't believe it that we want to own Wells Fargo here, but I think it's a decent opportunity here, and I think we can target those something near the $55, something near the previous swing high in 2022. Not a bad little idea here, and we can use this risk level that the market gave us to get in and get out pretty quickly here, right? So as of right now, we did pull back on Friday. We're pulling back into overhead supply that we traded under for about a year and a half, which gives us a decent confidence level that the market will turn this area from a resistance into a support, and we could potentially capture that $55 area. If we go to trading, Tasty Trade rather, excuse me, go to Tasty Trade and we pull up the Wells Fargo chain. I think we're going to be wanting to look at like April, May's, or June's. Let's go for June's first. Said 55. 57.5, something like this. Not a bad little idea here. Let's go back to Trading View and kind of just check that out. Yeah. So we can grab the Junes. You have plenty of time, 178 days, 28.6 IV with a 21 IV rank. Not a bad little setup. You can go for the 55s or the 57.5s, but I think I'm partial to the 55s here. Anything under like $1.75, I think is pretty okay on these. You're getting a little bit of a discount right now because you're pulling back. So the most you can lose here on this specific play is $153 if you only grab one. Obviously, if you grab more, the most you're ever going to lose on this specific setup is exactly how much you pay right? So what we're going to want to do with Wells Fargo is if we do buy those $55 calls under 175 max, we're going to want to run a stop that's pretty close, currently trading 49. If we start falling below 47.5-ish, we're back within this range. We don't want it. So we're going to cut the position sub 47.5, but we're going to want to hold it if it bounces here off of the 48.50 area up towards that 55 price target and beyond. Who knows? We do have an earning catalyst coming up here on the 12th of January, which could give us the juice to get up and over that 55, assuming we do continue to break up here. And as always, if we do find ourselves in a winning trade, close half at 100%. And just realized it wasn't showing trading view there. Close half at 100%, let the other half continue to ride up towards that price target. Decent opportunity here to grab a large cap financial space. We do expect the financial sector in particular to continue to run. And like I said, there is that earnings catalyst coming up on the 12th. We can position ourselves relatively cheaply before, and that might give us the juice to push us up towards the 55. Okay, so this has been a little bit longer of a Markets in Focus. Hopefully, I showed you guys a bunch of stuff to show you that maybe next year is going to be more bullish than bearish based off of stats, not my opinion. Try in 2024, hold your trades a little bit longer. I think you're going to really surprise yourself. And also, last thing I'll say here, guys, if you find yourself in an echo chamber of doom porn and bear posts and assholes that want the market to fall so they can make $5 on their puts, the best thing you could do to improve your trading is to remove those people. Not necessarily saying you have to have only bulls, but root yourself in fact and price and not ego and sentiment and opinion. You're going to be able to trade better. I challenge everybody that comes into TTI to really audit their followings list on Twitter, because even if you're in the best position ever, if you're consistently reading stuff that the market's going to fall, you better close your positions. You're going to end up making the wrong decision just based off of all of those voices coming in at different angles. Even if you're in a great spot and you have no reason to sell, the worst thing you could do in the market is not lose a trade. It's to cut a great trade early because you just don't know how far that thing's going to go. All right, my name is Hamilton. I'm here with the Trading Initiative. If you like this type of content, please like and subscribe, leave a comment below, and I'll catch you in the next one.